This is the Wintrust Business Lunch on WGN Radio. Jason Turner is the Chief Investment Strategist for Wintrust Wealth Management. Jason, welcome back to the show. How are you?
Doing well. Nice to be with you, John.
So inflation ain't been licked yet, huh?
Yeah, I think we've seen the last 2 months' worth of inflation prints come in a little hotter than we would have liked to have seen, certainly hotter than the Fed would have liked to have seen, and that likely encourages them to hold off a little bit on any sort of rate cut while we see inflation make sustainable progress towards their 2% target.
2% target. And what's the number we're at right now?
At the 2% target, we compare to today on an annualized basis at 3.8%, so almost twice on a headline basis where the Fed is targeting. For additional context, those last 2 months were a 0.4% month-over-month increase. To be on target for that 2%, we'd have to be somewhere less than 0.2. So the last 2 months have been twice as hot as they need to be for the Fed to feel comfortable that we're at 2.
Well, there's more than one way to calculate inflation, right? Like sometimes you can put things in and pull things out. 3.8, that sounds higher than I thought.
Right. Economists, we like to add things and take things out of inflation calculations. You'll often hear us subtract food and energy from an inflation calculation. The Fed also prefers a different measure. So we're talking about CPI here. The Fed prefers a different measure called PCE. PCE tends to look a little bit more benign than CPI through the current lens, but still in excess of the Fed's target.
Well, then let's use that one. So I wonder what's the most relevant to a consumer. What in fact have I been seeing at the grocery store, the gas station, the shoe store, all the goods that I buy for my home? I wonder how much actually inflation has been weighing on the prices.
Well, it's important to note when we're talking about inflation in these aggregates, we're talking about everything in a giant basket of goods and services, and not every consumer feels that. So when we strip those out and start looking at the various components, we can definitely see things like food inflation. Over the last 3 years, food prices have risen more than in the 10 years prior combined. So in certain segments, we're definitely feeling it a lot more in our wallets than in an aggregate number. For example, that aggregate number is a third owner's equivalent rent or the cost of housing.
I guess what you and I say doesn't matter. It's what an individual, feels, how much they're earning, how much they're paying. So everybody probably has their own individual inflation rates. But I wonder, just in general, how good or bad is it? Like 3.8% is less than 9%, but it's more than 2%. So I wonder, what a sort of estimation is or qualification is for inflation right now. Just one more question about perspective on inflation. 3.8% is a long way from 2%, Jason. Can you just give me some perspective on how much more expensive it is for people? Should they be noticing that it's less expensive than it had been, or is the cumulative price increase a real burden for folks?
I think you hit the nail on the head with the last part there, John. It's a cumulative increase. We're talking about positive numbers on inflation percentages, whether we're talking 2% or 3% or 9% like we were some 18 months ago. Prices have just gone up. Some of those are sticky prices. So, example, price of eggs has been as high as $5, as low as under $2. That moves around a lot. But something that's sticky, like the cost of healthcare or the cost of your shelter, the place where you live, those go up and tend to stay up. And those are impactful to consumers. If we look at consumer spending, retail sales is higher on a nominal basis, on a year-over-year basis, by just under 1%. But if we factor in the impact of inflation, we're actually seeing retail sales lower by nearly 3%. That's because of that impact of inflation. So in effect, we've paid more and bought less stuff.
I think, though, sometimes 100 years ago, milk cost a dime. So it's more expensive now. And if you just woke up, you'd go, wow, milk is really expensive. But everything gets more expensive over time. This comparison to, say, 4 years ago or 3 years ago, of course, we had that 9% hump during the pandemic. But I wonder if you started at 2019 and just said, okay, 2% a year, we'd be at 8 or 10% more than the cost back then. That's just what happens. So I wonder what prices would be today if we hadn't put all of that money into the economy during the pandemic.
I don't think you would have seen the levels of inflation that we saw over the last couple of years had we not had that fiscal stimulus injected in the economy. The flip side of that coin, though, is you would not have seen the economy grow at the rate it has over the last 3 years. I think if we subtract the stimulus, you're talking about 2025 or 2026 before we're back to economic output levels that resembled where we were in 2019 without stimulus. So there's a good and bad side to that coin. The bad side is we paid for it with higher prices. The good side is the economy recovered faster.
Yeah, so the question is, if knowing now what we do, would we do it again? Maybe the answer is yes. Maybe this is just the bitter pill we have to take. We're still taking it.
Yeah, I think the answer may be, would we do as much? And if we did a little bit less and took a little pain for a little longer in terms of economic recovery, we wouldn't be dealing with higher prices like we are today. Many of those prices are going to be sticky and are going to stay at their levels on a go-forward basis.
Are you optimistic about the markets in general this year? Is this week just maybe a little bit of the inevitable?
Yeah, I think I'm cautiously optimistic about markets this year. From a year-to-date perspective, the S&P 500 is already up 8.3%. Just this month alone, we're up 1.1%. So even with this week's pullback, sort of a snap reaction to hotter than expected inflation and what will the Fed do or what will the Fed say at their meeting later this month, I would think that American companies have that tailwind behind them of strong consumer that's still spending money. Maybe they're slowing down a little bit, but that's okay. And a Fed that is going to act to take some of the restrictive nature of monetary policy off the table as we move later into the year. I think markets are seeing that. They're pricing it in now. And the risk to the downside would, of course, be if inflation reaccelerates and the Fed completely backs away from the idea of rate cuts, because those cuts, again, are starting to look like they're priced in.
Yeah, right. So, I drew the line for rate cuts this year at 3.5. Are you taking the over or the under on that?
I will take the under on 3.5. 3 is probably the right number to me. If I had to put odds on it, I'd call your line at 2.5. I think we lose sight that this is an election year. The Fed typically likes to stay neutral from an election perspective, so that takes out the fall for the Fed to really get serious about action. So we're likely looking at a cut in June or July, provided we don't have any other destabilizing inflationary numbers. Maybe a cut in September, coming off their Jackson Hole meetings in August, and then that leaves December for another cut. Very unlikely they would do anything at the November meeting within just 2 days of Election Day.
Yeah, right. So if you drew the line at 2.5, you'd take the over. But who wants that? I drew it at 3.5, hoping I could sell somebody on 4 rate cuts. I'm not having any luck this week on that.
Give it another week or two, and we'll get some more inflation data as we come to the end of March. They'll corroborate what we saw this week. You likely might get a taker on that 4.
Okay, nice to talk to you. That's what we do in March. All the games and all of that. That's the kind of penny wagering I'm doing. Jason Turner, it's always a pleasure to visit with you. Thanks for your thoughts today.
Thanks for having me, John.